On the 24th of June 2017. This week in economics from WBRN Radio in Boston and on the Bostonred Network. We look at macroeconomics here, and very interesting how it is set up and what it plays in the modern day economic landscape as opposed to yesteryear. We have a story here from Vox, and we'll get to it in a minute after we do these PMIs from market, about a disaster in Indiana. It was a carrier plant. If you recall, DJ Trump taunted jobs that he would save there. And the caption of the story, or the theme, is that saving a few jobs here and a few jobs there doesn't really matter because macroeconomics rules. The economic landscape is now a global landscape. This is the reason we'll go into these PMIs. Let me just move to the PMIs here. And it is a different kind of situation. At one time, fiscal policy was there. That's what the feds do in various countries. And, of course, here, the dual mandate of full employment, basically 4.5% is what economists now term, and the Fed as quote-unquote full employment. Now, we're not talking about the labor participation rate. That has sort of disappeared out of the quote-unquote general news, especially from the DJ Trump White House camp. He used to talk about it, but not at this juncture. And part of the problem there is obviously the aging population. You're going to run about 62. That's what you're going to get. And the same basically is for GDP. GDP, we have some forecasts here that came out from the Merrill Lynch people. We'll get to that. At about 2.3 there. On the Ronald Reagan, you had about 3.4 some years, but again, that was in the 1980s, much a smaller economy. Let's go to these PMIs here. We'll first go with the U.S. PMI, flash PMI from the market people. This is the Purchase Managers Index on the 23rd of June. The Composite Output Index at 53, it was 53.6 in May. That's a 3-month low. These are key findings. The Flash U.S. Services Business Activity Index at 53. It was 53.6 in May. The Flash U.S. Manufacturing PMI at 52.1. It was 52.7 in May. 9-month low. It was a 3-month low for the business activity and a 3-month low for the composite index. The Flash U.S. Manufacturing Output Index at 52.9. It was 53.7 in May, a 9-month low. Let's go a little bit deeper into this as we set it up. The private sector firms have recorded further solid expansion of business activity in June, but there was a loss of momentum since May. This is highlighted by the seasonally adjusted IHS Market Flash U.S. Composite Output Index falling from 3.6 to 53 in June. The latest reading signals the slowest upturn in business activity for 3 months. And just a second here. The fastest since, wait a minute, just a minute here. And the manufacturing sector flash output index at 52.9. The latest increase in manufacturing output was the least marked since September of 2016. There are more positive developments in terms of client spending, with private sector companies recording the sharpest rise in new work since January. The greater sales volume contributes to a rebound in business optimism to its strongest level since the start of 2017, with service providers particularly confident about their growth prospects for the next 12 months. Staffing recruitment also picked up in June, with payroll numbers expanding at the strongest pace for 4 months. Meanwhile, input cost inflation remains soft than the 22-month peak seen in April. However, the average prices charged by private sector firms increased at the fastest pace so far. A number of survey respondents cited efforts to avoid squeezing margins in June. The seasonally adjusted ISH market flash U.S. Services PMI Business Activity Index eased to 53 in June, 53.6 in May, the slowest output since March. June data points to a robust accelerated rise in new business intakes across the service economy. The latest increase in new work was the fastest since January, when combined to further rebound of job creation from April's low. Meanwhile, service providers indicated an upturn in their expectation for business activity during the next 12 months. A degree of confidence the strongest since January. Input cost pressures intensified in June, while survey respondents linked to higher staff salaries and rising raw material prices measured overall. The rate of input cost inflation was the strongest in 2 years, something we will be watching here. The effort to evade pressures on margins led to further solid increase in price changes by service firms. The latest rise in input prices was the fastest since April of 2015. At 52.1 in June, down from 52.7 in May. The seasonally adjusted ISH market flash U.S. manufacturing purchasing managers index pointed to the slowest improvement overall business conditions since September of 2016. The weak PMI reading largely reflected softer rates of input and new business growth in June, which more than offset stronger contributions from job creation and inventory building. Meanwhile, the latest survey data reveals a marked slowdown in input price inflation to its weakest since March of 2016. Lower cost pressures lead to moderation in factory gate price inflation in June. The latest rise in manufacturing output charges was the least marked since September of 2016. The commentary here from Dr. Williamson. He is the chief business economist at ISH Market. The economy ended the second quarter in a soft note. The June PMI survey shows some payback after a strong May, indicating the second weakest expansion of business activity since last September. The average expansion seen in the second quarter is down on that seemed in the first 3 months of the year, indicating a slowing of underlying pace economic growth, while official GDP data are expected to show to turn higher in the second quarter after an especially weak start to the year. Our recent GDP tracker, based on various official and survey data, points to a 3% growth. The relatively subdued PMI readings suggest there are some downside risks to the extent to which GNP will rebound. Historical comparisons of PMI against GDP indicates that PMI is running at a level broadly consistent with the economic growth at 4/10 quarter rate, 1.5 amortized, and the second quarter, and just over 2% once allowance is made for residual seasonality in official GNP data. There are signs, however, that the growth could pick up again. New orders show the largest monthly rise since January. Business optimism about the year ahead perked up, and hiring remains encouragingly resilient. The survey is indicative of non-farm payroll growth of approximately 170,000. Average price charged for goods and services, meanwhile, show one of the largest rise in the past 2 years, pointing to improved pricing power amidst healthy demand. A little bit of a comment here. Normally in the summer months in the U.S., we have growth that is, I would say, average level. 3% could happen, but we probably look more to 3% in Q3. Wait a minute, let's make sure we're going here. We actually are going to Q3. So Q3, perhaps, but there are some problems here, as Dr. Williamson points out. In going to Q3, there's some underlying problems here, and we'll get to weaknesses in the market, as the market, particularly in the area of petro, and looking there again, you're looking at speculative market there, commodities, but commodities mirroring it. The market is overpriced. Stock market in the U.S. is overpriced, and there's some adjustments have to be made there. Now, to the psychology of business, it is not as optimistic as it once was, but according to these PMIs, it's a little more optimistic. We'll see. Let's move to a different PMI here. Well, we'll do the UK one very quickly, UK being a smaller economy. Key points here: sharp deterioration in household finance in June, containing a trend seen so far in 2017. Household indicates a further steep rise in their cost. Growth of workplace activity moderated to an 11-month low. Around 34% of UK households expect the Bank of England to raise the rates at the end of 2017. And let's move down here. The index is at 50.7, while construction workers signal the sharpest upturn. Job security, meanwhile, fell in June, with the rate of decline in most marked since October of 2016. The only employment sector to buck the downward trend were construction. That index was at 58.4 in June, and utilities, energy, and transportation at 50.5. Cost of living inflation expectation at 78.4 in June. The seasonally adjusted index shows that inflation perceptions remain elevated, bay below the 4-month peak seen in February. Households also anticipate a sharp increase in living costs during the next 12 months. The seasonally adjusted index rose to 87.9 in June, up slightly from 87.6, one of the biggest readings since mid-2014. Around one-third of UK households, 34%, anticipate an increase from the Bank of England. The figure's up from 31% in May. Meanwhile, just over half, 58%, expect a rise in the next 12 months, closer to 3/4 than anticipated prior to that. Now, on financial well-being in comparison to the trends seen during 2015, 2016, that said, the latest deterioration was at least marked in 2017 so far. The June data indicated higher cost of living remaining a key factor, placing pressure on households. Income from employment increased for the fifth month in June. That'd be reasons, obviously, for the bank to move its rate up. Although this did not prevent a further sharp reduction in cash available to spend, survey respondents also reported greater aversion to major purchases, as well as sustained decline in household savings. Not a very good sign there. Expectation for finances in the next 12 months. UK households are downbeat about financial prospects over the next 12 months, which continues a trend since April of 2016. Adjusted for seasonal influences, the index measuring expectation for finances in 12-month time dropped from 47.1 in May to 45.8 in June, signaling the greatest degree of pessimism for 3 months. Worries about the financial outlook were driven by people working in the public sector, with sentiments falling to its weakest since 2014. Workplace activity, job security incomes suggested the UK economy backdrop continues to soften. This was highlighted by seasonally adjusted index measuring workplace activity easing to 52.9, down from 53.5 in May, the lowest since July of 2016. People employed in the retail sector reported an outright decline in workplace activity at 45.5%. From an economist there, Tim Moore. June's survey revealed that UK finances remain under intense pressure from rising living costs, which squeezes the moderated slightly since last month. Worries about the outlook have deepened. The degree of concern about prospects for financial well-being was among the greatest seen since the end of 2013. Households also reported the largest drop in job security since October of 2016. The survey indicated that the only 1/3 of households anticipated the Bank of England raising their rates in 2017. However, more than 58% expected higher interest rates on a 12-month horizon. They didn't mention the negotiation called Brexit, but we'll see. All right, to Japan, and let me see what else we got going here. We'll do Japan. The manufacturing index down a 7-month low at 52 in June. That's in Japan. Flash manufacturing index of 52.1. It was 54 in May. The Nikkei Flash Japan Manufacturing Purchasing Managers Index, published on a monthly basis approximately 1 week before the final PMI was released. The PMI is the earliest available indicator of manufacturing sector in Japan. The estimate typically based on 85 to 90% of the total PMI survey. And we'll get to comments. The manufacturing PMI survey, this is from Paul Smith. He's a senior economist at IHS Markit, which compiled the data. Slow growth was a signal in June, with both orders and output rising at the weakest rate since last year, amidst reports of slight softening in market condition. That said, extended demand is holding up well, and the sector continues to operate within solid growth range. This helping support employment gains, whence also enabling firms to pass costs to clients to the greatest degree in its overall 2.5 years. So much for Japan. On we go to Germany. The German PMI composite output index at 56.1. It was 54.4 in May, a 4-month low. The service PMI activity index at 53.7. It was 53.4 in May. That is a 5-month low. The manufacturing PMI at 59.3. It was 59.9 in May, a 2-month low. The German flash manufacturing PM output index at 60.5. You can see it's much higher in Germany, 61.1 there. Private sector output in Germany continues to expand strongly in June. That's according to the PMI survey from ISH Market. That said, the growth slowed to the weakest since February, with both manufacturing output and service business activity increasingly slightly softer than in May. The weakest price pressure since November of 2016. The flash German composite output index registered at 56.1 in May, down from 57 in June. In May, the slowest rate of expansion since February. Output has risen continuously since May of 2013. Sector data signal the manufacturing output continues to expand rapidly. The rate of growth was the second fastest since April of 2011, easing only fractionally since May. In contrast, service business increased at a slower rate since January. The online strength of business conditions in Germany's private sector was highlighted by sharp increase in volume of outstanding business. In June, backlogs rose at the second fastest rate in over 6 months. There remains contrasting trends between manufacturing and service. However, the latter are experiencing only a fractional buildup of outstanding business, while the manufacturing backlog increased at the fastest rate since April of 2011. Those delivery times lengthened to the greatest extent since 2011. Also, cost pressures moderated in June. The rate of input price inflation slowed for the third successive month to the weakest since November of 2016. Goods producers continue to report supply bottlenecks, while support overall input prices. Also mentioned lower prices for metals and metal and the input of storage of stronger euro. Meanwhile, output prices charged by German private sector firms also increased at a weaker rate in 7 months. Although the private sector output growth eased in June, the 12-month outlook for business volume remains strongly positive. The future output index fell from May record level, but was needlessly the third largest since the combined manufacturing and service expectation series began in 2012. Manufacturers were more optimistic than their service sector counterparts. In a goods-producing sector, easing in output growth was reflected a slight drop in the market flash German manufacturing PMI 59.3 from 59.5 in April. This was nevertheless an indicator of the second strongest overall performance of the sector. New business received by German private sector firms continued to expand sharply in June, of a weaker rate than in May. That's pretty normal. The private sector employment in Germany continues to expand at historically sharp rates midway through 2017. The rate of job creation slowed to a 6-month low, but was needlessly among the fastest registered since employment last began rising in November of 2013. Commentary here from Trevor Bosching, I think. He's a senior economist at Market. The headline output index for Germany declined for the second time in 3 months during June, according to flash estimates, but needlessly remain at a level indicative of strong economic growth. The average reading for the second quarter at 56.7. The latest data signals a growth in the performance gap between manufacturing and service. However, goods producing sector continues to outperform the headline PMI, little changed from May's 73-month high record. Although growth in manufacturing output, exports, and jobs all eased slightly, expansion in backlog, and very important that new orders gathered pace and supply bottlenecks intensified. In contrast, service output growth at the weakest since January, and new business growth softened to a 9-month low. The gap between output and new business indicate for manufacturing and service were both the widest since January of 2014. Moreover, service providers increased employment at a slower rate in 14 months. Well, the German economy is subject to ups and downs as any actor in the global economy is, and this was incidentally on the 23rd there, but things are better in Germany than in Japan and in the U.S. Now, it's all relative. We look at it from a relative standpoint. It is relative, but again, this is a global economy, the ups and downs of a global economy based upon a demand. And if you're looking at global demand, well, global demand is up, global demand is down. And one of the things obviously happening there, as in the United Kingdom with Brexit, we have many more problems there. Let's go to, I think we'll highlight the catastrophe, what do you want to call it, layoffs at the carrier plant. This is just one example in the global economy. Production of work is shutting down, not because there isn't demand for the product, but because the company is determined it's more profitable to do work in Mexico. Now, this is the plant that DJ Trump visited. The transition is preparing for 600 layoffs of manufacturing workers. That'll be in July. That's from CNBC's Scott Cohen, who observed that the deal Trump and Mike Pence, he used to be the governor of Indiana, struck to save the plant is not living up to the hype. Well, obviously it's not. Per the terms of the deal, Kerry will continue to employ slightly more than 1,000 people at the plant, but of those, 700 are manufacturing jobs that augment the argument, the rest are engineering, technical jobs, period. Kerry is getting $7 million from the state of Indiana, which is pairing with $9 million of its own money to make a $16 million investment. Now, it is owned by United Technologies. The CEO there, Hayes, told CNBC in December that the money would go towards more automation in the plant, ultimately resulting in fewer jobs. And another case here is the Ford automobile company, rumored that it was shifting its focused production to Mexico. That was a win for the new Trumpism, but evidently they are not going to Mexico. They're going to China. So, in other words, things have changed. The carrier deal was essentially the high point of the presidency. Well, they pushed that around. The situation was absolutely a triumph of public relations and not much beyond that. The sheer amount of time and money expended per job was too high for the president. And when we look at this, unlikely, since any President Trump's record is driven by big picture macroeconomic factors, not small-scale deals. Now, that is to be remembered. These small-scale deals and 1,000 workers here, we've talked about this, and 1,000 workers there, are just a drop in the bucket. When you have hundreds of workers and thousands of workers in other workplaces being made redundant. He inherited an economy that had a labor market in decent shape, no doubt about that for the time, but was suffering from a sluggish productivity growth and still seems somewhat short of full employment. Depends on how you define full employment. Taking office, we continue to see steadily add jobs, may at a somewhat diminished pace in 2016. This is a modern industrial capitalist society, and we thought we would bring that in, so we kind of look at the overall of where things are and where things are literally going to in those terms. Now, let's go here to the Reuters. Wait a minute, just a minute here. Single-family homes rebound. This is from the Reuters service. In May, single-family homes sales rose in May, and dropped. And the drop in previous months was not as steep as previously reported. This is from the Department of Commerce. New home sales increased 2.9% to a seasonally adjusted 610,000 units last month. The April sales pace was revised to 593,000 units. Economists at Reuters had forecast new home sales, which make up 10% of all home sales, rising at 5.4% to 597,000. Well, that's pretty good. Last month, from the previously reported 569,000. Sales were up 8.9% on a year-over-year basis. May sales increase came after April sales were revised to show a similar drop. A smaller drop, than the month. Housing market has been boosted by continued job growth. The unemployment rate fell to a 6-month low, actually below the 4.5 to officially 4.3% in May. Mortgage rates are still favorable by historic standards. However, increase in the cost of building materials, shortage of lots, and labor cramped the home building with demand outstripping supply. Housing prices remain elevated. The median price is at $345,000 in May from $310,000 the prior month. Across the region, 4 regions, sales were mixed. They fell 25.7% in the Midwest, 10.8% in the Northeast, and rose 13.3% in the West and 6.2% in the South. Inventories of new homes on the market increased at 1.5% to 268,000 units. May sales rate, it would take 3.5 months to clear the inventory. And the inventory has to be cleared during that area. Now, this is from the Department of Commerce. And somewhere here we have, let's see, here we go. I think basically the same thing here. This is released on, the next release is, this was the May release, but the next release will be on the 26th of July. Basically the same thing, I believe. New sales were a seasonally adjusted rate. Yeah, we've seen it. We find some. This is a joint release from the Census Bureau and the Department of Home and of Housing and Urban Development. 2.9% above the revised April rate of 593,000, 8.9% above the May 2016 estimate. The sales price, we'll run over that, we won't go back over it. Sales inventory and monthly supply adjustments, that was already in the Reuters article, and that was the end of it. Okay. Let's see what else we got going here. Oh, the Merrill Lynch notes. We don't want to forget this. There was well, wait a minute here. Just a second. Get back here. The Whole Foods deal. Walmart is now in that mix. At least they're saying they're in the mix. Not sure how much they're in the mix at all. You just get the drop in Petro leaves a stain on earnings. This is from Reuters. Heading into Q2 earnings report, investors are looking for continuation of strong U.S. economy to justify stock prices being high. This is the other shoe. Drilling a hole in that hope scenario is the current bear market in petrol prices, and the economy shows signs of growth below the expected level in earlier the year. Lots of expectations for recovery in earnings is predicated on oil prices being around $47 to $50 a barrel. That's from Hugh Johnson. He's the Chief Investment Officer of Johnson Advisors in Albany, New York. If you don't get those numbers, you don't get the strong earnings in the market. Now, that said, crude oil here at at CLC1 had been under pressure, a glut there. The average over 48 per barrel so far in the quarter, but tracking around $43 a barrel on Friday. And one of the problems with the glut here, oil pricing it is a commodity, has been above actually what it should be. So in other words, it should be around 45 to around $40 per barrel. For our estimate, earning expectation have dropped for 10 of 11 industrial groups since April, with only industrials looking better than they did. And this is one of the things that's happening here. The benchmark S&P 500 index as a whole is expected to deliver a 7.9% profit growth, down from 15% in Q1, below the 10% forecast in April. That's by Thomson Reuters. The Nikkei will be the first Dow component to report earnings for recent quarter. The season heats up in the second week of July. We'll get the reports here from many of these operations. Technology earnings are posting double-digit growth, helped by gains in semiconductors. Financials are close behind with estimate 8.1% growth. The energy sectors are seen in a whopping 638% from a year ago, when many of the companies post losses, according to this is Thomson Reuters. Without energy profit growth, the estimate drops to 4.8% in the quarter. Expectation for the sector will probably come down to the second half of the year, and that is David Jolly. That is usually, he's at the Ameriprise Financial Organization in Boston. Usually the second half of the year, when you start talking about Q3, Q4 are the most important quarters normally. Q4 for the final, particularly in the retail sector, but Q3 you get into, or used to get into, the back to school, holidays are out, etc. And we'll look and we'll see. Let's see what else here. Estimate of 127 to 116 below. Well, anyway, the consensus here. Oh, this is the price in petrol prices. Notwithstanding some analysts of caution that Wall Street has been too optimistic about overall earnings. That is usually always the case. CEOs to start talking down their forecast, no doubt about that. They talk it up, then they start talking it down. Citigroup U.S. Economic Index, a gauge of economic data compared to expectations this month, fell to a 6-month surprise index. The Atlanta Federal Reserve's model recently forecast second quarter economic growth continuing at 2.9% amortized, down from a 3.2%. Well, 3.2% was not in the cards. Now, we're not saying it couldn't be, but we don't think so. Another hurdle for growth, declining corporate buybacks. Over the past 2 years, more than 20% of the S&P 500 issues have given at least 4% tailwinds for earnings per share, via reduced share count. For the first quarter 2017, that rate fell to 14.8%, and there are indications of less support in the second quarter. So we're seeing things, those tailwinds go downward and not upward. Let me just see before we leave Reuters here. That is the energy sector and overall where the market is, at least tentatively, let's just say that. Now, we'll get this Indian news in here. This is one of the outsourced Infosys. So this is an Indian company reassuring long-term goals due to reassessing. I'm sorry. This is Infosys. That's the second largest software service exporter. Is reevaluating its long-term situation. Due to a tougher market conditions, have appeared darting, as that's from their chairman, at the IT service company was likely to struggle to reach its ambitious $20 billion revenue target by 2020. Still reevaluating the long-term goals, faces new challenge in its biggest market, the U.S., as the policies of DJ Trump, visas, etc., it does play into things, and obviously they have to go where things tend to be. So let's go to the BBC, and we'll start to wrap this up. Toshiba trouble still continues on as the Japanese giant delays its final earnings report. Probably very wise on their part because of the looming financial crisis there. And the stress tests have started. We talked about this last week. U.S. banks, so far they've been passing. I believe they're moving to the second round here. Results could make it easier to convince policymakers. This is for downturn, the stress tests, as they call them. The tests were put in place after the financial crisis. They trigger a combination of losses of nearly $500 billion over more than 2 years. Now, the Federal Reserve tests to see how many banks with $50 billion, that's 39.4 billion pounds or more, would respond to the events of a global recession if unemployment increased to 10% and property values declined. So the combined losses of 50 billion over more than 2 years, including 383 billion from loans, but firms have enough cushion to handle such a blow. As from the Federal Reserve in 2009, 34 firms had added more than 750 billion in common equity capital were added by the Federal Reserve. According to Jerome Powell, he's the governor of the Federal Reserve, who had urged some regulatory reforms, said the tests showed that even during a severe recession, our huge banks would remain capitalized. Well, perhaps so, perhaps not. The second and most closely watched round is due next week. So that is there where the banks are. From our standpoint, those requirements should remain because part of the problem is the way the economy, the global economy is set up. We have to always wait and see what will arise, and to have the cushion is a very good situation. We should have Glass-Steagall, where we break up some of the larger banks. We'll talk about that in a different broadcast. From Amazon accuses Walmart being a big bully. I'm not sure how that plays out. Evidently, one of the problems Amazon has is they don't have enough warehouse space for some of their ambitions. Amazon was accused of rival of attempting to bully the IT company into picking a rival platform. Followed a report by the Journal, which said on-name large retailers also asked the vendors to shun Amazon Web Services. Now comes the time Amazon is expanding its shopping operations. Seattle-based company announced a takeover of Whole Foods this week. A reveal that it has struck a deal with Nike to sell sportswear shoes directly. It also will launch Prime Wardrobe, a service that lets customers order and try clothes for 7 days before deciding to buy them and keep them. Okay. Amazon Web Services division may not be well known to the public, no doubt about that, but those of us that lurk around IT, we know about them. In April, the company reported that the unit had generated $3.7 billion in sales over the previous 3 months. Some of its clients, GE, the CIA, and Netflix. Oh boy! According to market researcher Gartner, Amazon Services leads the market in its field. However, there are rivals out there, and this is Microsoft's rival. Walmart uses Azure. That's Microsoft's product. So we acknowledge that it's concerned about its suppliers' use of Amazon services. Our vendors have the choice of using any cloud provider that meets their needs and their services. It shouldn't be a big surprise. There are cases in which we prefer our most sensitive data isn't setting on a competitor's platform. That's a very interesting situation there. But when you're in the kind of business that they're in, it's a little bit different kind of situation. I'm talking about Amazon and Amazon itself and their services based upon their big retail platform. You're going to see a lot of that. You're also going to see a fight with a legacy corporation, and we could call legacy both Walmart and Microsoft as a legacy types. Microsoft has tended to move into the clouds to bypass its legacy beginning. Walmart is under increasing price pressure from various people. The German food operation, Aldi's, and various others have all come into the business, so it's not what it used to be. Let's do the numbers now, and we'll move along here briskly. When you look at the PMIs, you sort of get an idea of what's happening in Japan, in the Nikkei, etc. The BBC Global 30, this is another part of the coin, down negative 40.64. In the FTSE, all shares was also down 5.47. This is on Friday, unless otherwise noted. In Amsterdam, at 0.11, they were not in the red. The DAC was, down 60.59. The Calc was down 15.81. In Brussels, they were also down 9.59. In Madrid, negative 79.10. In Zurich, negative 18.38. All these markets were down. In Moscow on Friday, 11.86. In Johannesburg on Friday, they were also down to 94.82. In Bombay, they were down 152.53. In Karachi, 857.85. In the positive range, in Lahore, they were down 45.11. In Colombo, 60. And in Tehran on Wednesday, they were down 131.30. In Sydney, 51.40. The Nikkei at 22.16. The Hang Seng in Hong Kong was down 4.48. In Shanghai, 10.42. In New York, a negative 2.53. The Nasdaq was 28.56. The Merck, that is a commodities market out in the Midwest city of Chicago, 3.80. In San Pablo, 1,046.17 in the negative, and in Mexico, 648.42 in the negative on Friday there, and in Sao Paulo on a Monday. On to the commodities market, the other shoe, as we will call it, the speculative market. That's where we get Brent crude. Brent crude was up. Futures was up 43 cents at $45.65. The spot was up 51 cents and at 50.29. West Texas crude was up 36 cents at $43.10. Basically what this is telling us, due to the market conditions, international market conditions, or gluttony, U.S. worldwide glut demand itself working on the use of petrol, that these markets are going to be up and down, and we'll start now to look at a gateway basically between, we'll say, 40, 45 there. I noticed the spot was up a little at 50, but you're not going to see $60 and $75 oil prices. Cocoa futures were up $50, and gold up $4.90 at $1,256.30. That was on the Forex. Let's see. Dubai gold futures up $4.10 at $1,251.50 there, slightly lower, but they're there. Silver was up 13 cents at $16.71. We go to the Euronext Life futures. Cocoa was up $29. Ghana in various countries, that is a lifeline for them. Robusta coffee was up $53. Boy, watch out for the coffee pot there. And white sugar futures, I'm not sure why we even do this, it's up $3. The Bloomberg Commodity Index was up 0.28 or 28 cents at 79.64. That was on a Friday. So commodities in general are up. This will do it for us. We'll see you next week here. And, of course, we have many archived, including our coverage of the Federal Reserve last week here on WBRN Radio. And our political broadcast at Bostonred is always, as they say, moving through the various situations. I checked. We have roughly, 2,500 of those when we start including Numbers Man in the thing and the open source report and various others. We have almost 3,000 productions archived. You can look back. We go back about 9 years when we started following Barack Obama in downstate Illinois. So we go back a long ways here in chronicling economic activity from the years of Barack Obama to now the DJ Trump years, and as we move forward. Have a good weekend, everyone, and for those in business, keep it a productive one next week. And for the consumer, the eye is on the prize. Evidently, there's consumer caution across many countries, in the UK particularly. In the US, of course, summer driving season coming. We'll be looking at petrol prices here, or gasoline prices here, and automobile sales, etc. Summer is a big time for automobile sales. Good day.